It's now my pleasure to introduce Scott Hazelton, Director of Construction Services with IHS. Scott will speak to us on the global construction outlook on the divergences in the world economy and construction markets. Scott is responsible for IHS U.S., Canadian, provincial, and global construction forecasts. His areas of expertise include housing, consumer spending credit, building materials, and construction equipment. He began his forecasting career with the housing sector more than 20 years ago. Ladies and gentlemen, please welcome Scott Hazelton.
Thank you, and thanks for inviting me here. I'm not sure there actually is a worse photo in the world of me than that one, so we'll go past it quickly. It's, I think, very appropriate that you're having your annual conference this year in Boston. As you know, the Red Sox are rebuilding, so we need a construction conference. And if you have any expertise in demolition, we may want to blow them up first before you rebuild. So I'm from the Boston area, so I can say that. And a Red Sox fan since I was, about 2. So what I want to do today is set a little bit of stage, a few slides on this, our forecast for the global economy, because that's what sets the stage for our view of construction spending. As I mentioned, I think in the materials for this conference, we had a sort of theme of diverging worlds, diverging markets, and what is affecting construction globally certainly is partly a function of oil. And with the American market and other markets, but especially the U.S. market, also exchange rates. So we're going to have a little bit of discussion about that forecast as well. And then we'll go into the forecast sort of region by region globally. So sort of the good news is that the world economy is picking up. Some countries with other ones, in fact, some very bad countries, we'll get to that in a minute. But on the whole, the world economy is improving. 2.6% growth in GDP this year. Next year accelerates to 3.3%. A lot of that, in fact, coming from the developed world. In the U.S. market, we've got consumer spending, which is beginning to improve. Home building beginning to improve, although we'll see in a minute, not all that fast. We've also got recoveries in the Eurozone, Japan. And on the downside, we've got China, which is growing, but at a slower rate. Certainly a source of some concern in terms of construction and also oil prices. And other big markets, if you remember the old BRIC countries, Brazil, recession, Russia, recession, India, the lone bright spot, China, slowing down. So the BRIC is not really a story anymore, other than maybe a bad story. And then in emerging markets, you've got different outcomes, most of them less good than they were 10 years ago, because of a lack of reforms when times were good, that has now made it hard to do business and make it more difficult to expand capital in an efficient manner. So I mentioned the great divergence. Over the past 4 years, GDP growth 2.5% to 3%. That's not a divergent. However, the composition has changed with the emerging markets that were once the darlings of banks and brokerage houses becoming less desirable, and the advanced economy is becoming more so. And part of that is this nature of flight to safety, or just why the dollar is going so high. But a lot of that is because of other issues. One is debt and deleveraging. These economies were oftentimes heavily in debt, but you would forget that if copper was going through the roof. And you look at it more carefully with fundamentals when metals prices are stagnant. Oil prices, when they fall, hurt oil exporters more than importers. Many of these markets were, in fact, oil exporters: Russia, Brazil, Venezuela, especially Russia and Venezuela. Central banks, we see some divergence of separate paths. The U.S. probably going to be increasing interest rates in the near future. Our bet is September. Well, Canada probably is going to be cutting rates. So you're going to see some divergence in central bank behavior, which also affects loans for construction. And then the rise of the U.S. dollar and the fall of other currencies, which we're going to have a slide on in a second. So Where is the growth in the world? Well, other Asia Pac has always been the growth leader. That's Japan, it's Asia less Japan. GDP growth, 6% on average for as far as we can see. Bit of a slowdown in 2015 and 16, but pretty much 6% growth. Sub-Saharan Africa, these are small economies, highly risky economies in many cases, but Nigeria, Kenya, Angola, some very strong growth markets in that region. Right now, the Middle East is a bit of a tough road to hoe for GDP growth. That does change, assuming oil prices come back, and they will come back, just not all that fast. And then the weakest growth, and unfortunately, still going to be in Western Europe, a huge construction market, second biggest in the world, but not a lot of growth potential. So oil prices. What's happened? I think we all know the story. They crashed in November, December, and they blipped back up a little bit. Now they've fallen back down. Well, OPEC has been producing oil without any real cuts. There is no traffic cop anymore in OPEC, so they produce as they wish, including the Saudis. We have high inventories in the US and in Europe. In the US, we've stopped drilling holes in the ground. It's been bad news for many in the audience. We haven't really stopped producing. Our production numbers are still relatively high. So there's a lot of oil coming on the market. Add to that the fact that Libya is showing signs of increasing output, which of course caused the problem in the first place last November. And now you've got the discussion of, will Iran come back on the market with the nuclear agreement? So on the supply side, there's a lot of supply still out there, not really been meaningfully cut. And on the demand side, yeah, the US is growing, but a lot of the rest of the world isn't growing all that fast just yet. And China slowing down is posing that major risk on the downside to oil demand. So you see this sort of inability for oil prices to increase. In fact, they've been drifting downward. This is our forecast, both in real dollars and current dollars. They aren't that far apart in the near term. Inflation is not a big issue in the economy. And you see the track record for this year is they're going to stay pretty low, we think, for the rest of the year. And they begin to drift back upwards in 2016 and 17 and beyond. But even in 2020, we're looking at prices that are still below $100 a barrel. So this is good news for oil-consuming countries and not so good news for oil producers. Now, exchange rates. The blue line is the key one for most of us. It's the exchange rate of the US dollar against major trading partners. And the key is that forecast line, the vertical line that tells you where we are today. And if you look beyond that, we actually have a little bit of appreciation left to go. So the worst of the dollar appreciation is behind us if you're an American company. It'll get a little bit worse the next couple of quarters, and then that's the peak. But on the downside, notice that even out in 2020, the value of the dollar is higher than it was at any point since 2000. So we are looking at a roughly long-term, I won't say permanent, but certainly a long-term case where we're going to be less competitive on a currency basis than we had been for the past 10 years. Exchange rates now against the Canadian dollar, basically we've achieved the maximum amount of appreciation we're going to see. It's pretty much stagnant. It's going to fall back a bit. The Eurozone, there's a little bit of appreciation left. That's mostly the Greece uncertainty, and frankly, Greece is not a big problem. But there's enough uncertainty there that affects the quality of the euro, and therefore that also a little bit more desirable. But that will also fade away. And against the yen, we've actually had the worst appreciation, but the forecast holds more appreciation against the yen because Japan is a fairly weak economy in the forecast. Decent growth this year. They really benefit from low oil prices, but all the structural issues in Japan remain once oil prices stabilize. So what's it mean for construction spending? This is a 5-year outlook, compound annual growth. So 2014 is the last year of history. 15 through 19 are forecast years. It's not, just to be clear, 14 is not actually in the forecast. Blue is cold, very appropriate for Russia, I suppose. Red is hot. And I would observe, we've sort of discussed Russia, Brazil being in recession. the worst of the blues. Much of Europe is now yellow. In fact, when we get to Europe, we're going to see Spain's having a pretty good time of it. So a base effect, a very, very poor history, improving quite dramatically. So we do see some modest growth in most of Europe. Orange is a 2% to 5% growth rate. It's a 5-year compound outlook. So in the case of the US, that kind of masks some very strong early years and a little bit slower later years in the forecast. But there are sort of two Europes, as we'll discuss. There's the southern tier, which includes the Spains and Greece, Italy, and the northern tier, the Germans, Germanic countries, the Nordic countries, and Britain. They've got a much better outlook in the forecast. So hence the oranges. In the red, India really belongs in red. Bangladesh belongs in red. China is in red only because it's bigger than 5%. We've dropped our forecast for growth in Chinese construction by a good 100 basis points over the past year. So it looks desirable. It is, but it is less so than it would have been if I was here a year ago. And see much of Africa also in that desirable territory. So globally, this data comes from our global construction outlook. We have a forecast of spending on construction by 74 countries, and about 25 building types. And so this is distilled mostly into regional discussion today because you can't do a forecast of 75 countries in 45 minutes. But globally, all segments are going to see growth on average in the 3 to 4% range. What this graph does is put the building types into 3 big buckets: residential, which behaves in a certain way with a certain bunch of drivers; non-res structures behaves in a different way with its own set of drivers; and infrastructure behaves yet again differently with a lot of government type drivers. So we look at these 3 big buckets. Of course, we do segment buildings into commercial, retail, healthcare, and so forth. And then the colored bars, light green is the Middle East and Africa, typically the strongest growing over the 5-year compound, but it's also the smallest market. It's about a $400 billion construction market, on the par with South America in terms of market size, compared to America at roughly 1.5 about now trillion, Europe at 2 trillion, Asia Pac at 4 trillion. So fastest growing is Middle East, Africa, but it's also the smallest market. And noteworthy is, in fact, the blue, dark blue, which is North America, pretty much a US story right now. Doing extremely well in residential construction, but also historically, considering it's a developed market, quite good in structures as well. Infrastructure tends to be the leading category over time because emerging markets need to invest in it in huge amounts to make any kind of improvement, become more developed. So that usually is the winner in terms of growth rates. Now, in our construction service, we take a look at risk and reward because we're economists. And how do you define reward? Well, it's growth. So the vertical axis is the compound annual growth over 5 years in a country. And the vertical axis is, in fact, risk. How do you define risk? Well, lots of ways to do that. We worry less about politics and war and more about long-term investment safety. So can you enforce your contract? Can you repatriate your earnings? Can you protect your intellectual property? These are the kinds of weights that go into the 5-year construction risk score, which goes from 0 to 100. And actually, Iran probably is around a 70 on this scale. I think you're looking at maybe Sudan being 100 or something. But what's kind of fun about it is you can then make these quadrants. So the crosshairs are the global average risk and growth for the total construction market. So if you fall in the upper right quadrant, you're above average growth, which is good, and you're above average risk. Now we'll see some slides in a minute where you look at the lower left, you're below average risk, below average growth, which is where you find most developed markets, not a surprise. What you want to look for are the countries in the upper left quadrant, which offer you above average growth with below average risk. And you want to avoid the countries in the lower right, which are going to offer you below average return and above average risk. So in this case, we're looking at mostly emerging markets, which tend to be higher risk with higher reward. And we won't go through all of them, but you do see China there at about 5.5%, 6% growth. But Egypt, recovering from the Arab Spring, some of this is a base effect. Indonesia is probably one of my favorites. It has slowed down recently. There are issues of doing business there and regulatory hurdles, but a relatively mature market for construction spending, fairly large, fairly good growth, and on a scale of 0 to 100, relatively low risk. And then Kenya, one of the better diversified economies of Africa, with a Silicon Valley of its own, Silicon Savannah it's called, but also energy potential, a fairly good Western rule of law given its British colonial heritage. So if I was picking countries, those are kind of the winners. Bangladesh has got a lot of growth, but a lot of it is infrastructure spending with World Bank financing and not really attainable to a broad construction audience. So looking at the regions, North America first, because most of us here probably care most about that one. We had a horrible first quarter. We all know that. Second quarter has been better, actually it's been quite good, and we think the rest of the year is going to be shaping upwards. For the US, that is. Now for Mexico, exports are solid with a cheap dollar and an improving American economy. Actually, investments flowing into Mexico and new car plants and so forth. Mexico looks pretty good. Canada is probably even worse than this slide suggests. Canada may well be heading for a recession. So that growth rate, that's only about 0.3%, could be even less than that when we get done with the next forecast cycle. Where is it coming from in terms of the US? Well, in the short term, a lot of it's coming from actually commercial property. But housing has begun a recovery. Employment growth is one key to that segment. All that really matters for housing is household formation. We had household formation of about 500,000 units, households, at the depth of the recession. We should form about 1 million households per year. Well, all those folks have been born. They're living in your attic or your basement or your garage. They're your kids. So they will get a job someday and move off on their own, and they'll form a household, and they'll buy a house. Now, the bad news is they probably have a lot of student debt, so they'll buy a house later than you did. And the other constraint on the marketplace is the baby boomers are retiring, and they're getting rid of their McMansion in the Northeast and buying a condominium in Phoenix. So we have this issue of first-time home buyers can't buy that home right away, and yet we've got homes coming to the market from retirees. So there's a bit of an imbalance that's keeping us from having a lot of new housing starts. And this year we may hit 1 million, but a healthy economy is 1.5, 1.6 million. We don't get there, in our view, until 2017, 2018. We've got a ways to go. You see some really strong growth rates, but 20% growth, 30% growth, but they're not taking us to a strong market until 2017. Now, once we get there, assuming that employment growth stays steady, we can be there for a while because we still have to make up for that pent-up demand, but we have to get there first. And so the near term is going to be, I think, a long climb out of the hole. Canada actually had actively slowed its housing market, still had a pricing bubble in some cities, and that's, I think, part of the problem they're having now with the economy is housing is just bad, compounded by, actually, oil is bad, compounded by a bad housing market that's leading to the recession in Canada. The US is a net oil importer, so low oil prices hurt us to some degree. In certain industries, hurts a lot. Certain states, it hurts a lot. But on balance, we do better with low oil prices. Canada, net oil exporter, has a reverse problem. They actually lose ground with low oil prices on balance. Good news for Ontario, Quebec, but bad news for all the growth markets in Saskatchewan, Alberta, Newfoundland. And in Mexico, eventually that market will recover, but if you follow Mexico, they had a large number of home builders that overextended themselves about 2-3 years ago. And they're still trying to dig out from that. So what you have is a lot of smaller guys trying to build houses, and they can do it, but they only can build so many. And so in spite of a decent economy, housing is being held back. Now on the non-res side, U.S. employment has surpassed its pre-recession peak. That means that any new construction, so any new employment has to find new space to work in. Now, of course, there is some shrinking of office space and so forth. It's not quite true, but in general, we're now at a point of less renovation and more digging new holes in the ground for non-res construction. It's been very strong for industrial until this year. This year actually will be a great year. Next year will be weak, and 2017 looks pretty much awful because with prices where they are for energy, anything that was under construction will get built because it's worth building, but new permits have ground to a halt, and you think down the road 18 months, 24 months that those things will begin construction, they're not going to be on the cards. So we do see industrial construction very weak in 2017, but the good news is office is strong, retail is, well, hotels are strong, retail not so much, is growing, but we had a pretty much of an overbuild next segment in the 2000s. Institutional spending, actually I kind of two tails there. Healthcare looks pretty good. This year it's okay, next year better, 2017 even better. Partly it's government money, partly it is the Affordable Care Act that says we want to add 40 million, 60 more people to the rolls, and we want to encourage primary care physicians at the expense of research hospitals. So not a lot of spending on brand new research hospitals, but a lot of spending on dock in the boxes and outpatient centers, and that kind of structure in the forecast. The bad news is education. If we're forming households at half the rate we should form them at in 2009 and 10, and even now we're roughly at break even, how many kids out there age 5 and 6 and 7 are there to go to school? So the lag in education is going to be out there for a while in terms of new school construction. Infrastructure, I think we all know, we underfund it in this country. We do it badly. We can't get a compromise worth anything in Washington. And so absent that, it's not feasible to get new big projects off the ground. And so we have a lot of small-term projects that get funded by extensions to the highway bill. But most new construction is going to be a function of new housing driving new sewer, new water, new roads to developments. Mexico, actually, the best outlook because we have an administration which is pledged to improve its infrastructure and open investment to the energy sector, which is how they fund it. So it's kind of a backloaded number for Mexico. That growth is a little weak now. It gets stronger as the forecast goes on, and those policies can kick in. Latin America, as I mentioned, we've got deteriorating investment climates. This is the economics of the region. Brazil is in recession, single biggest economy by far. Argentina is not all that far behind with all kinds of issues. If you want some really fun stories, I've got them for Argentina. My favorite, actually, I'll tell one. So don't twist my arm. If you're, Argentina was worried about its currency value. So you want to slap on, or you don't want to, but they did slap on export controls. You could only import to the country as much as you could export. That way you'd avoid the GDP imbalance because you're going to be flooding the country with imports. So if a German company that imports Audis to Argentina and they export fruit, it takes a lot of oranges to make an Audi. And so when you put this policy in place, how do you make that work? Well, you buy a winery and you export wine as well. So, I mean, it works, and you now import cars and you export wine and fruit. But think about that from a business investment perspective. You're not going to go there if you're a foreign business in that kind of environment. So that on steroids is Argentina, because they actually they index their debt to whatever the CPI they want it to be. So their interest rates on their debt is a function of their inflation rate. How do you keep your debt payments low? You manipulate the inflation rate. So no one believes Argentina inflation anymore because they just pick a market basket that's lowest for that month. Now, if you're a banker, you want to lend money to somebody who is playing with your rates. So all kinds of problems in Argentina. Venezuela, that's in the news. We won't go down that road. But in general, the economies in Latin America that are pretty much open markets, Colombia, Peru, notably, actually got a pretty good outcome. And if you look at that graph, that map of the world, there was a red country, that was Peru, that had the best growth in Latin America, best growth in North America, in fact, in the Americas, is Peru. But long term, this is a region with, it lacks infrastructure, it lacks a lot of regulatory openness. In fact, I think I got it, yeah. Ease of doing business. In the US, we complain a lot about our regulations, but on a scale of 1 to Venezuela, we look pretty darn good. Okay, so you can almost follow the construction growth chart along the spectrum of the bad news. This is the GDP picture, which we won't go over. This is for your, these slides are going to be yours after the conference, so it's really for your benefit only to have this one. What I want to do is talk about the outlook for construction spending, and it's very much varied, as you might expect from that discussion of the economics. Colombia, good. Peru is on this bar chart because it's small, quite good. Panama is strong, but a lot of that is actually Canal Zone, major projects in Panama City, not always attainable to the broad construction audience, much of it already under contract. Brazil, this is a 5-year compound growth rate, and a 5-year compound basis, Brazil's construction growth is 0.3%. That includes spending for the Olympic Games. It's just a world of hurt right now, mostly because of government policy. And this, as we take a look at building types, but I think I've talked long about Argentina. So in the global construction outlook, we take a look at also within non-res structures, industrial buildings, office buildings, commercial buildings, which is everything but office. So lodging, retail, car dealerships, warehousing, institutional is government buildings, schools, and healthcare. And in most emerging markets, you see something where institutional is actually kind of either really big because the government's pouring money into it to buy people's happiness, like the Arab Spring, or it's really low because they just don't care. They get bigger priorities, like, say, India. So Latin America actually looks pretty good on the institutional score, kind of in the middle of the road. But industrial is kind of weak, and this is a case where, again, 3 years ago, a better view, mostly because we thought Brazil would become the regional powerhouse of manufacturing. It's just not happening. You see that in the risk-reward chart. Brazil, by far our biggest economy for construction spending, in that really undesirable location of below average growth, and badly so, and barely above average risk, most of that, in fact, regulatory. And you see Venezuela kind of off the chart to the right, off there with Iran if we had it. But there are some good news. You know, Honduras, Bolivia, tiny economies, above average growth, above average risk. And then Colombia, Costa Rica, Panama on the edge there of being above average growth and below average in risk. Western Europe, still gaining momentum, mostly because of consumer spending. As I mentioned, there's 2 Europes. There is the manufacturing intensive countries. You give the Germans a cheap currency with the quality of their products. I mean, basically, if you want to buy a really good machine tool, America, Germany, Japan, and the Germans have got a cost advantage of 30%. So good news for them. Good news for the Swedes, same kind of thing. So you see this better GDP growth in these markets, weaker in France, Spain, Italy. Even so, this is our forecast for Spain's GDP. Recession is over. Officially, actually, it was over last year. This didn't feel like it. This year, that's the best GDP growth, I think, in Europe. Again, base effect, but they're kind of doing what Ireland did. They're coming out of it quickly. Portugal, not quite so fast. Italy, not at all, as you can see. 2 years of recession, this year growth about 0.5%. So that southern tier, some weakness. UK, also doing very well. So what does it mean for construction spending? Well, this is total construction spending. I think I kept it at a high level for Europe because it doesn't vary all that much across the categories. UK, by far the strongest. A lot of that's coming from infrastructure with government policy, some of that coming from housing with a relatively strong market in spite of a relatively weak population growth. The best turnarounds, Spain and Ireland, for construction as well as the general economy. And if you're going to worry at night, I worry about Italy and Portugal more than I worry about Greece. Actually, I really worry about China, is what I worry about. But if it's Europe, you worry about Italy and Portugal. By building type, I mentioned the UK is quite strong. Germany, population growth is poor. That actually is coming out of renovation work, improving houses, because consumer spending is quite strong. So what's your most important investment? Your home. The Germans aren't stupid. They put the windows just like we did back in the 2000s. Non-res structures, that follows the employment growth. So again, you see the UK, Germany doing well, but Spain picking up nicely. The problem with Spain is, at the peak of the housing market, Spain was building something like 1.6 million housing units per year. That's what America builds in an average year. That's a lot of Norwegians going on vacation to the warm climate. So it wasn't sustainable. That growth rate is coming off a horrible decline. This is a spectrum of Europe, almost all of it, in fact, that safe zone, low risk, low reward, except for the UK, which is in the above average growth zone. In Turkey, I've got a slide on Turkey in a minute. Turkey is kind of a odd country. I was there about 3 years ago, had a cab driver who was actually educated at UCal Berkeley, and so he knew English very well. And I said, well, is Turkey, when I go to Germany, they say, well, Turkey's not part of Europe, it's part of Asia. So we go to America, we think, well, Turkey's kind of part of Europe because of NATO. Where does Turkey belong? I said, do you think of yourself as being Europe or Asia? And he said, yes. So that solved that question. We have it in Western Europe. We also have it in Eastern Europe. There's a slide on in a minute. So we're as badly deranged as the Turks are. In terms of the European outlook for economic outlook for Eastern Europe, they had a pretty tough year in 2014. 2% decline in spending. Res was up. Non-res was the problem. And the biggest problem with that is Russia, because of that $400 billion construction economy, half of it is Russia. And when you come to think about Russia, most of that is energy related, so hence the decline on the industrial piece, which really squashed the region. It's hard to see that coming back. Now, the good news is it stopped being a drag because the worst is kind of behind us. But without a huge recovery in Russia, it's hard to get the Eastern European region to increase. There are spots of good news. Poland is doing quite well. Poland is sort of what to Germany what Mexico is to the US. It's a place to get cheaper manufacturing for your own companies. And actually, the southern tier, Slovakia, Czechoslovakia, are doing okay. Ukraine has got, obviously, its problems. Now, this is a different slide for most of the regions. I want to share it because the success of this region in the early part of the 2000s was ascension money. Western Europe helping Eastern Europe become more modern to link the economies. With the worst of the recession behind us, that money is flowing again. And this tells you who it's flowing to. And the good news is from Romania, from the standpoint of awful to good, is the biggest change. Although the real winners are coming out of Poland and Hungary, and again, all that being German money. Outside of Turkey, most countries are looking at losses of population. So the left-hand chart is population growth, which apart from Turkey, isn't growing. But the right-hand chart shows you what's happening with urbanization. That is, people moving from rural areas to urban areas. Usually, we talk about it with China, but actually it's happening in parts of Europe. So the outlook for Hungary and Poland is also reinforced by this movement of people, which requires building new units in urban areas, and of course putting in the other utilities to make that work. So on the res side, we sort of see that in the numbers. The Czechs and the Hungarians, the Poles doing very well. Romania had the fastest growing construction economy in the world in 2005-06. When the money went away, it crashed to be the worst economy in the world, at least one of the worst. So some of that 3.9% is a base effect. On the non-res structures, again, that follows the money, as I mentioned. And as the GDP growth is strongest in Poland and Hungary, so you see their non-res structures. And then finally, infrastructure. This is where most of the ascension money is spent on the roads and the water and the sewer. And so the winners on that investment side, Slovakia, Bulgaria, you see here as the growth leaders. In terms of risk, it's a really nice, tight cluster. Russia, Ukraine off in their own little world because they kind of are right now. And then most of the region clustered around the global average. APAC, we've got two regions left. APAC by far the most important. So who benefits from low oil prices? Anybody who imports oil. China, Japan, India, South Korea all do better. India does better spectacularly because they have had fuel subsidies from the government. You take those off, you'd have got more government money to spend on something else, like infrastructure. And India had an inflation problem. You take away any kind of, you actually give deflation because of low energy costs, you solve your inflation problem. If you solve your inflation problem, you solve your interest rate problem. So low oil has been a boon for India of anybody on this list. Japan benefits because consumers get more money, but Japan's pretty much stagnant population growth anyway, so construction spending only gets so much of a boost from that. India gets a bang. Now, other countries have got problems. Indonesia, Australia, Malaysia, if you're a natural resource intensive economy in today's commodities market, you've got some problems. In Australia, especially as primary supplier to China, if you look at we have a global link model, global economy, and we can shock it. So what happens if you have China go down the toilet? Who gets hurt the worst? Well, number one is Angola, because something like 80% of all of Angola's fuel goes to China. But number three, I think, is Australia, because of its linkages for raw materials. And so China was seeing a slowing investment as the economy tries to rebalance. I'm not sure actually it's succeeding at that. India we got slides on India in a minute, but it certainly is reviving. Indonesia, growth around 5%, which is good GDP growth for Asia, not spectacular. And in general, a decent region. This is that same spectrum of ease doing business. Singapore, almost like doing business, in fact, better than doing business in New York. Hong Kong, pretty good. South Korea, pretty good. And you see the problems in the outer spectrum, in India being pretty much off the charts bad. But as bad as 142 is, that was probably 180 a year ago. Prime Minister Modi has done some real work in making India more accessible, and that's showing up in the investment numbers. GDP growth, China declining, India ascending. Now, China's still by far the biggest economy. India, even growing at 8% when China's at 6.5%, is not going to overtake India in our lifetimes. But it certainly is a better bet in terms of growth. When you see the other economies, my favorite one probably is Indonesia in the region. I mentioned China's shifting. It's shifting not only just GDP, but also industrial production. So if you're supplying equipment to China, you have the same problems if you're trying to forecast construction in China. It's all slowing down. It's slowing down by Chinese standards dramatically, from growth rates of 10, 15% to growth rates of 5%. So I would say this is not a blip for China. This slowdown is a permanent event for China, and it will probably even slow further as time goes by. So a big market, and actually that's not bad growth to have on a remember the chart of the country of the world rather with relative size. Still a pretty darn good performance, but slowing down. If we read Adam Smith, because I forget, I'm an economist and you aren't, but he talked about the invisible hand of the economy. Well, in China it's not so invisible, it's quite visible. Literally parking money wherever they want to have something occur. Left-hand chart shows you what's happening with investment share, not dollars, but investment share into real estate versus infrastructure. And the key is those past couple of months where we've seen infrastructure being juiced up to offset the decline in real estate. And juiced up by the by hundreds of billions of dollars. In fact, probably even $1 trillion is what I've been understanding. On the right-hand side, you see fixed asset growth in key areas, and again, look at the relative position of infrastructure versus real estate. They are shoving all the growth into infrastructure. Real estate, in fact, is a shrinking share of their investment. So just bear that in mind when you look at numbers. The residential construction number is actually relatively strong. It's government spending on social housing. It's not private spending on private housing. It's important to understand that distinction in China. So in fact, on the left-hand side here, we've got floor space, and the key is starts are badly underwater. Sales have fallen quite dramatically. So you see that the real estate sector as private real estate is in a world of hurt. On the right-hand side is a similar kind of story with land development. This is important because when you read all about the construction of railroads in China, that's funded, a lot of it, by state government, and it's funded by selling land. So the financial structure behind these railroads looks a little less solid when you look at these land charts. I don't want, not to cause alarm, it's still a fine economy, but if you're used to growth at a high level, it's not there, and it's not going to be there. But this is a economy run by professionals. They've been very good at avoiding hard landings in the past. Our baseline forecast is they will again, but that probability of a hard landing is probably around 40%. It's higher than it has been before. India outpaced in terms of growth. This is sort of the economic slide. I took it out, sorry. I had a slide for India construction as well. I was trying to cut down the number of slides before I sent this thing out. What you see in India is infrastructure is by far the strongest growth category, and it is for some time. And most of the government reforms have been tied to making that an easier market to enter. You can own more than half of an airport. In the last 5-year plan, India fell short of virtually every category of construction spend but airports. Why is that? Because you can own more than half of an airport as a foreign investor. You can control your destiny. As they loosen that restriction on, say, retail, you can now own more than half of a shopping mall. Surprise, surprise, retail has picked up. So as they continue these improvements in regulatory reform, you'll see more money flowing into India. And they have to have that foreign direct investment coming in because domestic savings aren't enough to fund the needs that they have. So in general, the construction region, we've sort of discussed India, Japan. Housing starts relatively weak, but construction spending is relatively strong by Japanese standards because of improvements. And Australia, not only is the non-res sector weak because of China, they've also had a bit of a housing bubble, so they're trying to rein that one in, and sort of compounding problems with the overall growth rate in Australia. So by segment in Asia Pacific, the dominant piece is infrastructure because of China and India. The other structures do well, just not as well. We kind of covered housing. Nothing I would add right there right now, I think. I mean, China, as mentioned, there is growth. So all the slides showing the collapse in starts, those are private starts. Public spending, in terms of being counter-cyclical investment, that is strong. That's what props up that 4% growth rate number. Non-res structures, again, used to see China in here at about 7-8%. That has diminished. India, that 8.2 is a little strong, I suspect, but recent evidence has been indicating that things are accelerating, and it's been a little bit backloaded. I think it's around 9% in 2020. So, but still, by far the growth leader in the region. Infrastructure, a similar story. Now, our famous risk-reward chart. Malaysia is not a big economy, fairly well diversified. It actually is in that nice spot of above average growth by a little bit, below average risk by a little bit. Vietnam, Bangladesh, Sri Lanka, also good prospects. Vietnam, a lot of companies have made a decision that, well, China might have a problem, and just to be safe, I'm going to put a factory into Vietnam, and if things go bad, I can ramp up production in Vietnam. So Vietnam does actually fairly well in terms of growth in our forecast. Not in this chart, but because we don't forecast Myanmar. Same thing's true in Myanmar. A lot of Japanese companies putting their money into Myanmar. So you see a pretty good outcome for growth there, but risk is quite high. So the last region I wanted to cover, Middle East, North Africa, not a surprise with weak oil prices, a lot of these countries have got curtailed construction markets. In fact, I think I'll just go right there and we'll spend our time on this one. We combine Middle East and Africa because frankly it's hard to find good construction data on most of Africa. So if you recall that global chart at the front, there's a lot of gray. That was countries we don't cover in Africa. But who does well? Well, most of the guys who do really well with higher growth are in fact in Africa. We discussed Egypt already, Nigeria, a lot of risk, a lot of actually probably political risk higher than business risk in Nigeria, but pretty good growth. Again, low oil prices have diminished that somewhat, but they've got a lot of other industries as well. It is the single biggest economy in Africa, so there are other segments, agriculture, that can pick up some of the slack. Senegal is not the big blue, that's Qatar. Senegal's little dot you can't see because Qatar is on top of it. But that is the best diversified economy in Africa, but it's small. Cameroon, they found oil. Kenya, they found oil. Tunisia, they wish they could find a little more stability, but they've got oil. So that's your high risk, high reward. Iran, it's 60. That was a little bit higher. I'm not sure we're going to see a drop into the 50s anytime soon. I think this, in terms of risk of doing business, won't change a lot just because we have lower sanctions. More money may flow in, but I think will still come with some risk attached to that money. Much of the region in that sort of cluster around the mean, Israel, pretty good economy actually in terms of size of the market. One thing I should mention in the Global Construction Outlook, we look at current dollars, there's nominal dollars, real dollars, we take out inflation, and these charts all in the day are real dollars because inflation is a huge problem in some of these countries. Growth rates actually may be double digits in Brazil, but you take out inflation at 12%, you end up at zero. There is another measure in that study, which is PPP, Purchasing Power Parity, which is important because in the global market sizing, in real dollars, Japan is number 3 behind China, US, and Japan. When you factor in PPP, so that the Big Mac index, what's really happening for construction, Japan falls to something like number 10. So again, with Israel, it's the same kind of story. It's not as big as it may look because of the cost of construction there. So basically, you do see a pretty good picture of the region where most of the Middle East is compressed under that low risk, around the global average of risk reward, and the other regions are higher. So with that, I wanted to give some time for questions because I went really fast through some of these regions. I'm sure some of you may want to ask something about oil or dollars or Argentina stories or something. So with that, I'll thank you and take some questions if you want. And I can't see a thing with the lights, so I have to tell me what's happening. Oh, that's better, thank you.
Taishik Lee from Korea. I knew the Chinese make the new bank, AIIB. So your expectation without having AIIB bank, and Japanese invest a lot of money with Asia Development Bank. What do you expect after making the new bank of Chinese?
I'm not quite sure.
Are you familiar with the AIIB?
Oh, okay, the Asian Development Bank?
Yeah, by Chinese. So with the Asian Development Bank and then AIIB bank, then it will be different economic environment.
Right. It's a really good question. I mean, typically those banks are designed for infrastructure improvements and they're designed to transfer money from developed countries to less developed countries. So you'd expect that Philippines, Bangladesh, Malaysia to some extent should be winners from that. In fact, we're already seeing Bangladesh playing India against China with money for development projects. So I suspect that there'll be some influence peddling as part of that bank. In fact, China, there's an African Development Bank as well. And the African Development Bank is funded, something like half of it, it's a huge chunk is coming from China. And again, the same kind of issue. The challenge with, all money always has strings attached, no matter where it comes from. But with China in emerging markets, it comes with a little more strings than other countries. So if you look at Algeria, for example, when they do construction spending with Chinese money, you end up with Chinese workers, Chinese construction equipment, Chinese engineers, and local Algerians don't see a lot of new jobs. And most importantly, they don't see a lot of new training. And so for other countries, Botswana has basically said we don't want to do business with China because we want to build our own human capital, and we can't do that. So I'm not sure that will be true for Asia as well, but my guess is it probably will be. So yeah, it's a good question. By the way, I do have, I think on the front slide I had my email address. So if questions come to you, next week, ask away.
Scott, just a couple of questions. First of all, it just seems like, the recovery from our Great Recession has been at a slope that has been less than historic. So it feels like it's going on forever, and one keeps wondering how long that'll go on forever. But it seems like from your forecast, it's going to go on forever, and construction spending will kind of follow that along at a much lower rate than in the past. So that's just confirm or say no on that one. Second question is, since Greece has is the size of Miami, the economy, why does Europe keep bailing it out?
Yeah, well, the first question is actually easier. So do you have like in-laws? No. So for the U.S. economy, yes, this has been the weakest recovery of any post-recession since the Great Recession, and probably even before that. But most of our government records start in 1947, so you can't tell a whole lot from 1890. Which there are a lot of other recessions out there that were actually almost as bad. In fact, if you want some fun sometime, the Great Recession didn't be that great. Government policy actually made it worse than it probably had to be, but whatever. The important thing, yes, this is the weakest recovery from a recession we've ever seen. Now, why is that? Lots of reasons. I mean, some of it is, in fact, imposing new regulations on business at the same time that they're trying to recover from a recession. That's not a good thing. But also demographics have not favored us. With the baby boomers retiring, some of the most productive workers leaving the workforce, not the best time for that. College loans, the debt situation of many of our younger folks who tend to take over as the drivers of the economy, that's been impeded. Oil prices, in fact, thank God for the oil boom in the Midwest, because that helped us in 2009 and 10 when construction was awful, and that, of course, that fades as construction begins to pick up, and you end up with, again, a muted effect of a construction recovery in many companies. But yes, the forecast is continued growth at a slow pace, 2.5%, 3% GDP growth for as far as we can see. Now, you have to have something to cause a recession. They don't just appear every 10 years or 5 years. Usually it's an imbalance in supply or in finance that causes the crash. So oil embargoes, the banking sector most recently, inventory accumulations. We just don't see a reason to expect one. I mean, certainly it's not going to oil prices. Inventories are pretty much in line. There's no, as far as we can tell, issue with banking insolvency. In fact, interest rates are quite low, which suggests that risk is quite low. So it's hard to see a downturn. The way economic forecasting works, it's like the weather forecast, only replace days with years. So you feel really good about tomorrow, next year, and you feel really good about the year after that. By year 3, you're beginning to say, well, there's a little bit of uncertainty. And then beyond that, years 4 and beyond, you're forecasting a trend. So there will be another recession. Our forecast doesn't show one out for 10 years, but year 7, there could be one. But certainly the next 3 years, there's almost no chance. To put in perspective, we do a macro forecast for the US, and we create a baseline forecast, which we call control, the most likely outcome. And we create 2 alternatives to that forecast. Now, they're basically a pessim and an optim, but not quite that simple. You assume, what if there's a tax increase? What if there's housing recovers quicker than we think? What if Iran comes to the market with 1 million barrels as opposed to 100,000 barrels? Those kinds of things drive alternative scenarios. You put a probability on those. Today, our baseline is 70% probability and equally optim pessim 15, which means that pessim is only about a 15% probability. In 2008, the baseline was 55, and pessim was, I think, 35 or 40. So to put in perspective, we're feeling pretty safe right now. So that's the US question. As for Greece, a lot of it's just pride, and a lot of it comes out of France. I think the Germans would have been happy to cut them loose. In fact, if you read Merkel's statements, she was about ready to let them go. But there is certain pride that in the European Union in general that we've put a lot of investment into this. People said it couldn't happen. We've made it happen. And if Greece leaves, we fail. So we want to keep Greece in. And that seems to have been a especially strong sentiment in France. And if you look at the big 3 economies, UK, Germany, France, UK is kind of on the fringe of the Eurozone anyway. They've got no Eurozone currency. They've got their own currency. So it's really Greece and Germany that care about the value of the euro. And I think just Greece, France kind of won out with other countries agreeing with it to bail Greece out for the 3rd time. And I think if Greece left, it actually is the size of Louisiana in terms of its economy. Yeah, it wouldn't matter. That's why people talk about the Greek crisis. There isn't one unless you're Greek. But and I don't mean to put it lightly, because there is a crisis if you're Greek, because you can't get money from the ATM. But I had the good fortune to be in Zurich a few years ago, and I was in a beer hall, because under extreme social pressure, I will have a drink. And I was sitting at a table with a retired Greek pilot who was all of 50 years old, whose son is going to school in Zurich at state expense. And he sees nothing wrong with the picture of retiring at 50 when you could live to be 90 in Greece, so you'll be getting retirement earnings for longer than you worked, while your kid is getting education at the most expensive city in Europe. This can't work. And that's kind of what Greece's problem was. It was just an overabundance of state largesse without any way to pay for it. And in a sense, historically, Greeks have been very good at avoiding taxes. It was the French paying for it. But.
Scott, given this is a U.S. directed question.
Okay.
Given the healthcare policies coming into more full fruition now, where do you see the trend for healthcare costs in the next 4 to 5 years? Pressure up, down?
Up. I don't have the exact numbers. It certainly is going up. In fact, we're seeing them already. But we've been very fortunate for several years to have a holiday. Healthcare costs have increased faster than inflation for many years, most of the past couple of decades, especially so in the early 2000s. But they've been on holiday for, 5, 8 years? Mostly because if workers are not employed, they don't have the pressure for benefits. That tends to help. And the threat of reform had insurance companies keep their premium increases in line. So we've had that sort of holiday. And yeah, our belief is it's over. We have healthcare costs increasing inflation by a wide margin. I want to say 5-6% inflation in healthcare costs, but if we can trade cards afterwards, I get you the exact numbers. I guess anecdotally, in New England, we're run by boards of selectmen, and I'm the chairman of my board. We're looking at budget in August for the coming year, and we're already looking at healthcare cost increases of 9% is what's being proposed for the insurance company. We have been seeing 5 and 6. So yeah, add about 300 basis points, which you're used to, and you're probably looking at a forecast for the next couple of years. We're going to take them down a bit. I mean, we budgeted, for an increase, not quite that much, but. Anybody else? Okay, so great. We're not having anybody. Perfect. Okay, so actually, I'm going to the dinner tonight. If you're there, track me down. Otherwise, thanks for your time, and drop me an email if anything comes up.